Hey everybody, hope everyone had a good day. This is the Emini review for Thursday, May 30th, 2024. And actually, we'll start with the weekly chart because tomorrow's Friday, so the weekly chart, support and resistance, is important. And my one thought on the daily chart was obviously the market's going sideways over the past several bars, but this channel by the bulls was tight enough that I thought the first reversal down would be minor. And so we are going below last week's low here. You can see we're down here. But the problem is that there's a couple problems. So this was strong enough up, tight enough channel that it will probably get some sort of second leg. So probably buyers below. Plus the low one sell signal bar, which is this, is a doji. It's a trading range. So probably buyers below for a couple of reasons. Now we may go lower, but the reason going into Friday, the weekly chart's important, is because the market will often do something on Friday to drastically change the appearance of the weekly chart bar. Now at this point, the week is probably going to close bearish. It's less likely we're just going to rally all the way back up here. But what the bulls want to do, probably the minimum for the bulls, is to get a close above the low of last week's bar, the low of last week, which is here. The next target for the bulls would be the midpoint of the week, and if they can close above the midpoint, they can say it's a buy reversal bar, even though it's a bear body. They put enough of a tail that it's actually a buy reversal bar. But even if they do that, even if the bulls had this bar closing on its high, it's still a bad high one in bad context. And for the bears, they just want to keep the bar going down. So far, it's a strong bear trend bar. The bigger the bar, the more disappointing for the bulls. So strong enough rally for a second leg, but if this is really disappointing, more and more traders may give up, and the retest might be a lower high before we go lower. For the daily chart, I've been saying we're probably in a trading range on the daily chart. And it's a tight trading range up here, but overall, the market is sideways. A couple legs up here, a couple legs down, a couple legs up. If the market is in a trading range, you know we're probably high in the range over here. And if the market's in a trading range, gaps are going to close. And so one target that might be on the daily chart is May the 7th high. And you can see we're approaching that actually today. From there, I don't know. The bulls might get another minor leg before we get another bear leg down. But I do think we'll probably try to test the midpoint of the rally at a minimum. And that would be somewhere around here. So I do think we're going lower. And for the 5-minute chart, I'm just going to draw. We had another gap down, so I'll draw yesterday's low. But I'll just not draw yesterday's high because it's so far and it wasn't important today. Coming into the day, I'm always thinking high probability it's a trading range day, and high probability on the first 6 bars that it's a trading range open. 80% of the time, that's the case. Yesterday was a trading range day, and today gapped down, and that's a breakout. So we have a bear breakout on the open, and then bar 1 closed a bear bar, and it's a bear reversal bar with prominent tails. It's not the strongest bar, but it is follow through for the bear breakout. So probably sellers above bar 1, but probably buyers below. It's a low 1, possibly 3 legs down, 1 pullback, 2, and then the climax or the gap down, 3. Bar 2, stop order triggered below bar 1, but far from the moving average. And You have to wonder, is this above average bearishness, or is it a breakout, a gap down that's possibly climactic, maybe a third leg down? What the bulls are hoping for is we get a failed breakout of the trading range. So we have the trading range yesterday, we get a bear breakout that fails and reverses up. But the open of the day and then the close of bar one, you can see we're significantly lower below all the bars to the left. And so for the bears, that's really good. Traders know there are bulls buying below the trading range, and they got trapped with the gap down. So this functions as a breakout. So right now, bulls are trapped. Bar 2, it's a buy reversal bar with a bear body, so a weak stop order and tight channel down. The first reversal up will probably fail. Probably sellers above, but they may not come in until above bar 1. The low of yesterday is also close. We may have to test that before we go lower. And then bar 3 poked above bar 2, but there were sellers above. And now bar 3, it's a technical low 1. Some traders will call it a low 2. The context is bad. It's a reversal bar, but a bull body, probably buyers below. Those buyers may not come in until below bar 2. And then bar 3, bar 4 triggered the stop order below bar 3. But if you're sold on a stop below bar 3, you know you're selling far below the average price, the moving average, and you know your signal bar is weak, so you need a strong entry bar, and you get bar 4, and that's fairly disappointing. So any aggressive bears selling below bar 3 may bail out of the trade after seeing their entry bar. And then we went outside up on bar 5. Bar 5, so it's an outside bar, and that's a trading range bar in the middle of a trading range. So in general, probably sellers above and buyers below. But now we're getting a second reversal up. It's a tight trading range, possible final flag after the bear breakout. And the odds are we'll trade above bar 1 because, in general, 20% chance bar 1 remains the high of the day. So in this context, it might be a little more dangerous to be selling above bar 5, but also not unreasonable. And then bar 6 overlapped bar 5. The majority of the bar overlapped bar 5. It's a bull bar closing on its high, and that's good, but the overlap is not good for the bulls. The market is really just sideways, and now, because of the tails, so we went up on 5, down on 6, up on 6. That may be 2 legs up, high in the range, probably sellers above 3, and like I said, sellers above bar 1. Bar 7, possibly 3 legs up. It's hard to see it on this chart, but if you looked at the 1-minute chart, you would see the market rallied, pulled back, rallied, pulled back, rallied. It's a minor wedge, and it's really a tight trading range. Probably sellers above. The bulls are hoping we get the breakout, but the bulls need to do more than what they're doing. The past 3 bars, yeah, they're getting bull bars, and they're closing above the prior bar's highs, and that's good. Plus the lows are trending. It's a micro channel, but on a smaller time frame, it's more clear that this is a channel, and these bars are overlapping by maybe 80% or more. So probably sellers above, and might be a late leg up high in a trading range. And then you can see bar 8, we triggered above bar 7 and then reversed down. Bar 8's a sell signal bar. Some traders might call it a low 3 because of the implied 3 legs up on 5, 6, and 7. The problem with selling below bar 8 for that wedge is that the wedge is minor. It's on a smaller time frame. So ideally, for this particular pattern, if you're trading it, probably would have been better to look for an entry on the 1 or 2 minute chart and look to sell higher, because if you're selling on a stop on this chart, you're being forced to sell in the middle of a tight trading range. There may not be much left down to the downside on this trade. Still a micro channel from bar 5 to bar 8, so probably buyers below. But bar 8 was disappointing enough that the bulls may get a bounce, but we're probably going to go more sideways to down. Also, the gap down, every bar today has been below the moving average. So eventually the market is going to test the moving average. and it can test the moving average by going up or by going sideways. And you can clearly see here we're going sideways. So if traders have been willing to sell below the average price for 8 bars, they'll probably be willing to sell once we test the average price. Three bars up, I know it's a micro wedge, so really not ideal, and it may not get a second leg, but also micro channel, probably buyers below. And then bar 9, bear breakout. Some traders call it a low 2 below bar 8, low 1 below 4, and then low 2 below bar 8. And like I said, this was a wedge on a smaller time frame, so to be trading this for a second leg was dangerous. And then you can see anyone who was long got out below bar 8, and bar 9 was a strong breakout. Bar 9, you can see after the close of bar 8, we have a tiny tail on the top of bar 9. And what that tells you is traders were selling the close with limit orders on bar 8, and there's a sense of urgency. There wasn't a big pullback. Look how much bar 9 pulled back and overlapped bar 8 compared to these bars. You can see there's less overlap. And then bar 9 was a big bar, the biggest bar of the day, and it broke out far below the bars to the left, so that's all good for the bears. The one problem that I have for the bears is that maybe it's now 2 legs down, and I do think this breakout is strong enough for a second leg, but I also think we've had a lot of trading range price action, so not ideal to be selling low. So strong enough for a second leg, but probably better to look to enter on the pullback. And then bad follow through on bar 10. So bull bar, but it's an inside bar, and it's a trading range bar. It's a minor reversal. There's probably sellers above. There's a gap from the bar 2 low. You can see we tested it on bar 10. The bears are hoping we keep that gap open, and really we keep the body gaps open. So right now, the bodies here do not overlap with bar 10. So right now on the line chart, there's an open gap because the line chart plots closes of bars. So far, decent breakout from the bears, but bar 10 being a bull bar is bad because it's not follow through. So bear breakout, but no follow through. But still, do you really want to buy above bar 10? Probably not. Bar 11, we have a bull bar, but possibly a buy vacuum test of resistance. You can see where we tested and where sellers came in. You have bears selling above who missed the breakout. You have bulls who got trapped buying below the bars to the left. They got trapped on bar 9. They scale in lower, and then they get the chance to exit at their original price on bar 11. So probably more sellers on bar 11, but might be strong enough up on bars 9, 10, and 11 that they may get a second leg. The odds are there's not sellers below bar 11. It's a bull bar, 2 consecutive bull bars, a fairly big bar, and low in the range. Sellers are probably going to want to sell higher. Inside bar on bar 12, and if you can imagine the 60-minute chart, we have a trading range bar, and it's bearish, so we opened here, closed a little lower, but there's big tails above and below. So overall sideways for the first hour, but slightly more bearish, and every bar below the 5-minute 20 EMA, and that's good for the bears. Right now, possibly a bear channel, so bears will sell rallies. We had a rally up to bar 11, they sold. Now bar 12, it's an inside bar at resistance, which is the body gap location, and it's an implied high 1, probably sellers above bar 12. The bulls might get their second leg, but it could be really minimum. And then instead we got the bear breakout 13, triggering the low 1, but it's a weak low 1, trading range bar, inside bar, low in the range. This was strong enough that there's probably buyers below. As far as buying, I think it's always in short, and I think it's dangerous to be looking to buy. Obviously, this is the more major breakout, bar 9, and 10 and 11, it's a bull breakout, bar 11, but it's minor, and it's overlapping bar 9. So if anything, I'd be looking to sell. But Selling 13 is not ideal. Because you're selling low, you're selling where sell to close bears, front running the breakout on bar 9, got trapped. And so if the market pulls back, those bears scale in, they get the chance to exit at their original price. They might take it on 13. And you can see we bounced, but instead we closed lower, and that's good for the bears. So we have 4-bar micro channel since bar 11. And in the past 2 bear bars closing below their midpoints, but still overlapping a lot of bars to the left. If you measure this breakout, we did break out to a new low, but look how much, I'll just draw a horizontal line. Look how much of this bear leg from the high of bar 11 to the low of bar 14, how much went below bar 9. You can see it's a fraction of it, so it's not a very strong breakout, at least not yet. Now at this point, you might have on a smaller time frame, bear breakout 12, pullback, breakout, pullback, and then a third push down, possibly a lower low, double bottom, with a wedge for the second leg. Traders are beginning to draw wedges. This might be the low. We may go lower, but even if we break out a little lower, the wedge channel line could be down here. Still always in short and probably sellers above. Just not ideal to be selling down here. So you will have bears who are short and maybe taking profits below bars. Bulls are buying below bars. This might have been enough of a rally that bulls will buy below bar 9. And then 15 broke out further to the downside, testing the channel line. It depends on how you had it drawn. So some traders say failed breakout of the wedge. But now 15, it's a doji signal bar, and it's a 5-bar bear micro channel. You'd be buying against 3 consecutive bear bars, so not an ideal stop order trade above 15. Some traders will take it, and when you have a stop order that has a weak signal bar, you need the entry bar to make up for it. The context is okay. You have 3 pushes down. The one problem I have is that we're completely below the moving average. If this pattern was more in the middle, if the 20 EMA was in the middle of these bars with some bars above, some below, it's a very different setup. But for now, there's a couple problems for the bulls here. So 3 pushes down, but we have a negative gap. The bodies of bars 4 or 5 do not overlap with 11 and 12. There's a gap on the line chart there. And then if you just think about the buying pressure today, we have a 2-bar rally here, but then they immediately sold it. Weak rally, 3 pushes up, and then big sell-off. I'm not sure if the bulls have done enough, but what the bulls are hoping is that 15, it's a high 3 setup, basically a wedge bottom, and we get a surprise bar on 16, a big bull breakout bar, closing far above, really ideally above a lot of bars to the left. But of course, at this point, it's low probability. What do you do here? I don't know. If you're a bear, bears are taking profits at new lows and selling above bars. Now we have a 5-bar micro channel, so sellers above, and that's one of the problems with the wedge bottom argument. 16, small bull bar, so triggered the stop order buy above 15. But if you're a bull and you bought above 15, how do you feel about your entry bar? It's basically at your entry price. And what the bulls have going for them is that bar 16 is a low 1 short, possibly low in a trading range. And it's a bull bar, so you know there's probably buyers below. But I think the upside, until the bulls can prove themselves strong and have more buying pressure, the upside here may be limited. Outside bar 17, so the market's going sideways. Market triggered the low 1 below 16, but now we've had a doji on 15, small bar 16, doji on 17. Probably going more sideways here, sellers above, buyers below. And again, it's always in short, and traders are arguing it's a bear trend. We have lower highs and lower lows. So if anything, better to be short or flat. 18, a small inside bar. Remember, by the close of bar 18, there's an 80% chance we've seen the high or the low of the day. This range is small, but of course at this point, it's more likely we're seeing the high of the day, maybe 30 or 40%. The bears are hoping we have a small pullback trend that lasts all day. And so far, there hasn't been anything too climactic. Bar 9 was a little climactic, but after that, nothing too climactic for the bears. And the bulls do not have much going for them. Now, the one thing the bulls did is they bought below bar 9, and now there's no gap. There actually is, I'll draw that here, there's a negative gap from the low of bar 10. You can see these bodies do not overlap. So the bears have two open negative gaps or body gaps. And they're hoping we have sellers below bar 18. It's a low 2 and a bear trend. And that further traps the bulls. The bulls are hoping it's a tight trading range down here. Buyers below, maybe buyers below 15. The buyers may not come in directly below 18, but it is a tight trading range, maybe buyers below 17. And then outside down 19, you can see where 19 tested. It tested the open of bar 10, which is that body gap price. And you can see the market is repeatedly testing that price, tried to break out above it on bar 17 and failed, tried again. You could say it tried on really the past 4 bars, and it failed in a big way on bar 19. Possibly a give up bar, but the bar is not that big, and traders are still arguing channel line. The odds of a successful bear breakout and then a steeper bear trend are about 25%. We may have to pull back to the trend line, but some traders might draw it like this. I don't know about that. It might be some sort of wedge. The point is, though, it's a tight bear channel. It's a bear channel. The lines are close together, and there's not enough buying pressure to be buying. Bulls will buy below bars for a scalp, but again, if anything, the bears are selling above bars, look to be short or flat. And then failed breakout of the channel line. Now bar 20, the bulls have something to argue with. 20 is a credible stop order trade. 20 is a bar that always in bears will get out above, and always in bulls, aggressive bulls will buy above 20, stop below 20, hoping we have an early low of the day, that this sell-off was a weak sell-off, and a wedge bottom that would become the low of the day, the lower tail on the daily chart, and then we rally and close the gap from yesterday's low. The bears look at this and say, yeah, it's a bear channel, and it's not breaking below. The bears are taking profits below, but the upside still may be limited. We've had 20 bars below the moving average today. And even though it's not the strongest small pullback trend, 20 bars is 20 bars. So like I said earlier, the odds are the first test of the moving average will get sold. This is a tight trading range since 15, probably sellers above 17. So good signal bar for the bulls here, bar 20, but now they need follow through. And then bar 21. If you're a bull and you bought above 20, you're obviously disappointed with your entry bar. For the bears, thought it was okay to get out above 20, and you can short below a bear bar, closing below its midpoint or near its low, like bar 21. But the problem with selling here is you might be selling a low 2 or a low 3, low in a channel, which is not ideal either. 20 was enough of a surprise that there's probably buyers below, and it will probably get a second leg. But again, probably minor. The upside's probably minor, but the upside's probably limited. But at this point, it's hard to tell whether this is a small pullback bear trend or if this is 3 or 4 legs down in a trading range, and then the bulls are going to get a few legs up. But again, like I said a couple times, it's really important that all these bars are below the moving average. That can really limit the upside for the bulls. Probably buyers below 21 and sellers above, but maybe above 17. And then another bull trend bar, 22. So bull trend bar, pause, second leg, 22. And it traded below 21, so trapped traders below the low 1 in a bad, or a low 2. You call it a low 1. Might call it a low 2. I might have said low 3. In any case, it's a stop order sell low in a range, and it's not ideal. And then 22, you have traders buying below 21 for a scalp. 22, good looking bull trend bar, but you have to understand the context. Possibly 2 legs up. Now we're above bar 17, where it's expected to have sellers. And you're still within all the bars to the left. And this is a minor lower high. So we have a lower high here, went to new lows. This is still below that lower high. So at this point, even if the bulls get up here, the odds are it's a trading range. The other problem for the bulls is the moving average. 23 needs to break straight through the moving average, and ideally would be a similar size as bar 22 with little overlap. So now traders are waiting for follow through. And then 23, no follow through, which isn't surprising when you see bar 20 get bad follow through and then a second leg up, possibly high in a trading range. So possible second leg trap 22. When you get 23 as a bull, I don't know if I'd be taking any chances here as far as buying below a bar like 23, or if I was long, hoping for that second leg. 22 was strong enough that it may get a second leg, but it could be really minor. And hoping for that second leg, you're trading counter trend. For the bears, we had a tighter channel, and now it's becoming more broad, but it's a bear channel nonetheless. And now we're at the moving average, and what do we know about bear channels? Is that traders sell rallies. We have a rally, weak follow through, another rally, and they sold. Probably sellers above bar 23. 24, so 23 is a high one, and then 24, bull bar, but almost completely below the moving average. Might be 3 legs up. It is a tight 3 legs up, so it may be a breakout on a higher time frame that may get a second leg. But 3, we have a bull breakout, pause, bull breakout, pause, then a smaller bull breakout. The bulls are not able to get above the moving average. The bears see a lower high double top with bar 11 and bar 24. Now 24 is not an ideal stop order signal bar. So as always, if you do sell below 24, you need your entry bar to be impressive. And then 25, the bull breakout. So now we're breaking far above the bear trend line. But if you look at the bull breakout since bar 20, it's not a micro channel. We have a pullback below bar 21, implied pullback 23. It's a bar in the opposite direction. One of the things the bulls have going for them is that the individual bull bars themselves are actually strong. But what's not so great is that most of the breakout is below the moving average. The bulls have 1 bar above the moving average, but what I say about this price, this was a major lower high. So we go above that, and the best case for the bulls is trading range. Now this was strong enough. Some traders see it as 1, 2, 3. So you might have exhausted bulls taking profits, aggressive bears selling above the lower high, selling a climactic bar 25. But the reality is, it was enough up by the bulls that it'll probably get a second leg. What about a 20 gap bar? 20 gap bar sell. We had 23 bars completely below the moving average today, so the odds were we'd find sellers at the moving average. But this rally was strong enough, the traders don't want to sell directly above strong bull bars. And then we get 23. You will have traders selling above 23, but then if that's your entry bar, they may look to sell higher, and that may be contributing to the buying on 25, which is that bears who sold above are giving up on that trade and looking to sell higher. So 25, it's a 2-bar breakout, and the body's getting bigger. But one of the problems is it's possibly 3 legs up and possibly high in a trading range. So the context is bad. We're testing the low of bar 8. That was a breakout point. So if bulls bought below bar 8, you can see we're testing it on 25. And again, 25, the first bar to close above the moving average, the bulls need follow through. And look at their follow through. It's non-existent. 26 is a bear bar, almost completely reversing bar 25. So 3 pushes up, aggressive bears, selling the close of bar 25. And then above this lower high, market's in a trading range. So at this point, the bulls have had a strong enough minor reversal that any retest could lead to a major reversal. The bulls see a significant trendline break of a bear trendline, and it is. But now they want a weak retest of the lows and then a decent major trend reversal setup. The reality is that the market's in a trading range with the majority of the bars below the moving average. At this point, we're probably high in the range. We may go a little higher, but if anything, I'd be looking to sell in this area. 21, it's an inside bar, or I said 21. 26, inside bar, but it's a high one. I meant to say it's a high one, and you probably have sellers above bar 26, but tight enough up, you might get a minor second leg. 27, you can see what happened with the tail on 27. You had bulls trapped on the close of bar 25. So if you bought the close of 25, that's your entry bar. You'll be happy to get out at your break-even price, your entry price, the close. 27 came close but could not quite get there before bulls just bailed out of the trade. Now we have an inside pattern, which is breakout mode, possible final flag. So we had a weak rally. Why is it a weak rally? I said the bull bars are strong, but the context is bad, and there are pauses between, so it's more of a biclimax, pause, and then even stronger biclimax, which is the third one, high in a range. Now you will have traders selling below 27, so probably sellers above, and I would not buy below 27. I keep saying this was strong enough for a second leg, and it was, but that doesn't mean it's ideal to be buying below. In this context, an possible final flag, high in a trading range, with a decent signal bar. If you did buy below 27, hoping for a second bull leg, 28's your entry bar. How do you feel about your entry bar? If you're a bull, you're disappointed, so bulls might give up below bar 28. Bears, now they're getting 3 consecutive bear bars, a 4-bar micro channel, might be high in a trading range. We're at the average price. After 23 bars below the average price, more and more traders might begin to sell. Again, this still may be strong enough that this is a minor reversal, and then we get a retest of the bar 25 close. But even if we do, the upside's probably limited. Sellers above. 29, it's an outside bar, almost an outside bar. Breakout below 28, but failed. And it's a trading range bar. Weak, high 1, high in a trading range. Really weak signal bar. It's a trading range bar. Sellers above. And what about below? You had bears who were trapped. Remember I said if you're a bear, you sold above 23. If you weren't quick to get out, and you can see 25 even tested the high, but if you weren't quick to get out, you may have been trapped above 23. So on that retest, we're testing that price here, and we're bouncing. May get a small, that could contribute to the small second leg up, but 29, not ideal for the bulls. Like I said, probably sellers above. 30, continuing lower, still a micro channel since 25. So a 6-bar bear micro channel, not ideal. There's a good amount of overlap. It's a channel on a smaller time frame, so possible spike, and then a channel, which is a bull flag, and then maybe a second leg before we get the retest of the lower prices. And then you can see the buy vacuum on bar 31. You have a 6-bar micro channel with not really an ideal place for bears to enter. Selling below 27 wasn't ideal. And of course, if you sold 28, your entry bar is bad. Selling below 29 is bad. And then you have bears not willing to sell. The equation got bad. The risk was getting big. The context was bad. So if you're a bear and you're short here, what are the odds we get all the way down here before we get the retest of this spike's extreme? it's not clear that it's 60% we're going here before up here. And if it's not clear, then it's not 60%. And if it's not 60%, you can't be in a trade that's 1-to-1 risk reward. And that is why we had to go higher to find sellers. Breakouts in trading ranges get deep pullbacks. I think 31, as strong a bar as it is, the context is bad. The bulls need to do more, and right now the bulls need follow through, and 31's overlapping all the bars to the left. So it could simply be a buy vacuum test of resistance. We have a leg up, pullback, possible second leg, high in a range. And you know the odds are, if this is a trading range, and when you look at this, you know it's a trading range with a bearish bias. The regime is bearish. We're mostly below the moving average. And what happens in trading ranges is gaps close. We have a gap here. We have a gap from the close of bar 19. So a couple magnets for traders below. And for the bulls, again, 31's a great bar, but the context isn't great, and the bulls need to do more. So traders will wait and see what the follow-through looks like. Aggressive bears will sell the close of 31 and sell higher. They'll sell the close of 25. They'll sell above 25. They'll keep scaling in above the high of the day. And look what happened on 32. Bad follow-through 32. So strong bull bar, but then weak follow-through. 31's a strong enough bar. You know it could get a second leg, but it's similar to buying below 27, which is risky. Because you know the second leg is likely to be minor. Just like this spike got a second leg, but the second leg looks like it's going to be minor and not symmetrical. The market's in a trading range, and it's high in the range. 32 is a double top, low 2 setup, but the signal bar is weak. So you can sell below 32, but you need a strong entry bar. And selling below a trading range bar after a strong bull trend bar, 31, is not ideal. The bulls were also able to keep 32 completely above the moving average. 33 is an inside bar, but it's a high 1, high in a trading range. Leg 1, pullback, leg 2, probably sellers above. 34, bull trend bar. Consecutive bull bars good for the bulls, but unable to close above 32 and the bars to the left, and that's not ideal. So this could be a nested two-legged pattern where we have leg 1, pullback, leg 2, and then leg 2 subdivided, leg 1, pause, leg 2. So hard to stay long here. If you're a bull and you're long, maybe stop below 31, you're long on the close of 34. What's your premise? It's good to think in terms of equidistant moves. So it doesn't matter if it's 2 points, 5 points, 10 points. I like to find the most recent swing point where a logical stop would go and the market price. So say we're here, what are the odds we go all the way up here before back down here? Clearly not 60%. And you saw what happened the last time that happened here, where the equation got bad for the bears, they exit the trade, look to sell higher. The bulls, they might be getting a bad trader's equation, and they may bail out of their trade and look to buy lower. Outside bar 35, we're going more sideways, high in a range. Still no credible stop order sell for the bears, but I think dangerous to be long here. And then 36, big bear trend bar. Closing near its low, closing at the moving average. Now we've had a strong enough leg for a second leg. We got the second leg. Traders will argue we even got a third leg because we have an outside bar 35. And then we got the bear trend bar 36. That's an always in flip. So if you're long, get out below 36. And bears will sell below 36. Where's the stop? Probably above bar 8 or bar 1. Sellers above 36, but probably going more sideways to down here. 37, buy climax, testing above 36, but probably sellers here. Strong bull bar, but the context is bad, similar to bar 31. or any of these bars that keep getting no follow through. So for the bulls, it's a great looking bar, but they need follow through. And then disappointing follow through. Disappointment is the hallmark of trading ranges. I keep saying that word, disappointing, because the market's in a trading range, and every breakout is getting disappointing follow through. 38, small signal bar, so lowers the probability selling below, plus it's a trading range bar after a strong trend bar. Probably sellers above, and if you do sell below, you probably need a wide stop. 37 might have been strong enough for a second leg, but maybe traders will draw 3 legs up, and you could even say it started somewhere over here. So bull channel, but a broad bull channel, and some traders will call it a wedge. You can draw it different ways, but the market's getting squeezed. We're high in a trading range. The bars are really overlapping here, and that's not ideal for the bulls. And you have to keep asking yourself, what's the trader's equation? If I bought above 37, going for 1-to-1, how's my risk reward? How's my probability? Well, maybe on the close of bar 37, it's hard to even say if that was 60%, but you know after seeing the entry bar 38 that it's 50-50 at best, and you can't hold a 1-to-1 trade at 50-50. 39, a high 1, high in the range, probably sellers above. If they're lucky, they'll get filled, but kind of one of those greedy situations where traders might just sell the close of 39. Outside down 40, so there were sellers above who got filled. Several wedges, I just drew one. There's a micro wedge here, probably going more sideways to down. Eventually the bulls are going to give up and look to buy lower, like below strong bull bars. For the bears, micro double top, wedge top, no great signal bar, but they are reversal bars, and it's been 3 bars since we had a bull body. So some traders will sell below 40 for a swing. Outside bar, 41, but could not close above the prior bar. Market's channeling up, but it cannot get consecutive bull bars. Bull bars are not closing above swing points to the left. The market's repeatedly trying to break out of a channel line and failing. And eventually, it'll try to do the opposite. Hard to sell below a bar like 41. Obviously, it's a bull bar. It's a big bar. So the bears will wait for a better sell setup. Inside bar 42, implied high 1. Good looking bull bar. It's closing on its high, but it looks like there was a tick gap. So the market actually went 1 tick below the close of 41 on the open of 42. That's a sign of weakness, and it's a late leg, might be 3 legs up, and a nested second leg. So leg 1, pull back. This is all leg 2, but it's 1, pull back 2, pull back 3. So I keep saying, really dangerous to be long in an area like this. You're high in a trading range. This is sort of a no-buy zone. 43, bull breakout and failed, and then reversed down, closing near its low. Big bar, so big risk. But if this is a trading range, this might be the high. The low could be all the way down here. So it's a reasonable swing trade. Did not trigger on 44, and instead 44 is an inside bar, but inside bar, high in a trading range, probably sellers above. And then 45, another bull trend bar. So the market is continuing higher. It's a fairly tight bull channel. The market's getting squeezed. We're getting the bull breakout of the channel line, but when you look to the left, where are we? We're breaking above the high of bar 1, the high of the day, trying to get to the low of yesterday. Even if we get there, the odds are there are sellers above. Now we have 45 closing above the high of the day, closing above all the bars to the left, and that's good. But the past 3 bars overlap. They overlap with these bars, they overlap each other, and 45 had a tail on top. So possibly here, leg 1, pull back, leg 2, not ideal. And then 46, there is another bar that you need to respect for always in traders. Bears will sell 46 and bulls will probably get out below 46. You can call it a parabolic wedge. You can see it's getting steeper as we get higher. And then we're high in a trading range, lots of overlap. And the bulls really unable to get decent bull bars above. The bulls can't get bull bars closing above prior bars. 46 a credible stop order short. 2 consecutive bull bars, 44, 45, and a micro channel since 41 all the way up to here. So it might be buyers below, and it may get a small second leg, but really dangerous to be looking to buy up here. 47 could be that second leg. Looks like the stop order did not trigger below 46, but high 1 above 47, inside bar. The context is bad for buying, probably sellers above. Another inside bar, 48, so II pattern. But when you look at this day, is it a bull trend, is it a bear trend, or is it a trading range? You know it's a trading range. You know the market is having a hard time at the high of the day. We're poking above and pulling back. We're breaking above, pulling back. We're getting overlapping bars. The bars are getting smaller, inside pattern. It's a triangle on a smaller time frame, and a possible final flag. Probably sellers above, and as far as buying below, I would not. 49, we have a reversal bar, so we broke out above the triangle and reversed down. Now we have a low 2. Low 1 below 45, and then low 2 below 49. Small signal bar, so small risk means low probability. You may get a bar that goes above 49 before the bears get a move down, but reasonable swing trade below 49. Bar 50, we have a high 2, so high 1 above 48. Broke out and failed, and then high 2 above 50. But is bar 50 a high 2 in a bull trend, or is it in a trading range? The problem with bar 50, a couple problems with bar 50. So bar 50, the past 3 bars have been dojis. The past 6 bars have been sideways. You could even argue the past 8 bars have been sideways, overlapping. It's clearly a trading range. And when you look at the structure of the overall day, big down, big up, we're now high in the range. Do you really want to be selling? Do you really want to be buying a high 2, high at the top of a trading range? Obviously not. So the equation's bad. For the bulls, the probability is low. The odds are there are sellers above bar 50. 51, we're getting the bull breakout, but big tail above could not close above the bars to the left. It hardly closed above 50 and could not even close above the past 2 bars. 51, at least for the bulls, is a weak stop order sell signal bar, but the context to be long here is not good. And then 52, so similar, like I said on bar 46, always in flip. 52 is another one of those bars, a strong bear bar closing near its low, with a lot of selling pressure on the way up, a lot of bars going sideways, tails above bars, and high in the trading range. And now this strong bear bar, really hard. This is not an area where you can buy below bars and then scale in, because we could easily come back down, all the way down to the bar 19 close, and I'll draw that because that is a magnet. Actually, a closer magnet that I'll draw first, the bar 21 high, trader selling above, never got a chance to exit at break even. If this is a trading range day, gaps are going to close. 53, we had a tick gap on the open of bar 53, so the close of bar 52 was 72.75, and then the open 72.50. So it's a 1 tick gap. So there's urgency. Traders immediately as the bar closed, bar 52 closed, and traders immediately want to sell the close and get short. If you had a limit order to sell the close of bar 52, the high of bar 52 tested the close of 52, so 53 tested it, but if it does not go 1 tick beyond it, you run the risk that your limit order probably will not get triggered, and if it doesn't, then you can see the market start going without you. There's a sense of urgency. 53, breakout of the moving average, but weak. Obviously closed above the moving average and well above its midpoint. But as far as buying above 53, it's a high one at the top of the trading range. Obviously, probably more sellers above. 54, the same as 53. Micro double bottom, so maybe slightly better for the bulls. But the best case for the bulls here is they bought below bar 51. They get a retest of the low of 51. And then we get a second leg down. And then instead, we couldn't even get there before we started getting the breakout down, 55. 55, could it be leg 1, pull back, leg 2, second leg trap? I don't think so. I think we're still fairly high in the trading range. And that red line down here, this open gap, could easily get tested. Still, we're just barely past the halfway point of the day, so there's plenty of time for this to be a couple bear legs down, a couple bull legs up, and then maybe some bear legs down in the trading range. Bear bar closing on its low, crossing the moving average, probably always in short, and cannot buy below 55 and scale in. Cannot buy below it at all. 56, we have a high 2, so high 1, 54, high 2, 56, but tight bear channel and bad context, sellers above. 57 did not trigger it, so 3-bar micro channel, 55 to 57, probably going at least a little lower. And then a little bit of a surprise, 58. You can see 58 came close to the price I marked, the high of bar 21, but did not quite get there. Now, even though there's a giant tail below bar 58, this was a strong enough breakout. It went far enough that you know it's probably going to get a second leg. And do you really want to buy above 58? Big bar, so big risk, tight bear channel, and a bear close. Obviously more sellers above. 59 could not trade above, so the micro channel, since 55 continues, and now we're at 5 bars, obviously more sellers above. Tight bear channel, probably going lower. This could all be one leg. Then we may pause, go sideways, pull back before a second leg down. 60, technically a high 1. Some traders might call it a high 2. We have a bottom and then a higher low double bottom, 60. Micro double bottom, but a small signal bar. There's been no significant trend line break. This is a tight bear channel, and so the only option here is flat or short. Broke the trend line on 61, testing the moving average. You know, traders got trapped at the moving average on 55. We went straight through it, and then we never tested it again, so we're testing it here, and traders are exiting. Bears who didn't short, they're getting short. This could be leg 1, maybe complex pullback, couple legs sideways to up before a second leg down. 61, it's a bull close, but it's a sell reversal bar at the moving average after a tight bear channel, probably sellers above. And then 62, bear trend bar. Some traders will argue we went sideways here, but still a fairly tight bear channel. Probably hard to argue buying here and scaling in because we could easily come back down to the low of the trading range. 61 was a low 1 short, but a bad signal bar. But the entry bar could be enough to keep bears in the trade. 63, bad follow through. So we are in a tight trading range for the past 5 or 6 bars. Market's going sideways with a bias to the downside. There's not much buying pressure. Even the buying up here was weak, but since here, the breakout bar 52, look at the bull bars. They have small bodies and big tails. They're overlapping prior bars. It's not enough for any major reversal. 63 is a low probability trade, probably sellers above. 64 outside bar. Some traders might call it a low 1, and it is a bad location. It's an outside bar, low in this trading range, but in the overall trading range, we still could get lower prices and probably sellers above. 65, we traded above. Now we have 3 pushes up. It's a micro wedge and a wedge bear flag on a smaller time frame. So bear breakout, 1, 2, 3 pushes up. Bears are looking to get a second leg down. Inside bar 66, but in a tight trading range the past few bars. The odds are there are sellers above 62. Bulls are trapped below the low 1, the bad signal bar low 1 on 61. And we did test it on 65. And we're testing it again 66. Buy vacuum, probably. The bulls need to do more here, and this could simply be a seller close bar. And then we went outside down 67. And so we have another outside bar. The problem here is we have had now maybe 10 bars sideways, and we're low in this range. Now we have an outside bar, expanding triangle. Not ideal to be selling down here. Usually better to sell above outside bars. If we do get the breakout, the chances are increased that we'll come back and test the breakout bar. 68, pretty much overlapping all the bars to the left. It's a weak bar, probably buyers below. But still, we don't have much buying pressure. We don't have a significant trendline break. We keep poking above, but for now, really hard to buy. 69, similar to bar 63. It's a small bar, but now we have maybe 3 legs down. So bulls will say it's a wedge bottom. And that's fair to say, but it's a minor pattern. So the best case for the bulls, we may test the top of this trading range, maybe the moving average again, but it's a low probability trade, buying above 69. And it's a small bar, small risk, low probability, probably sellers above, but they may not come in until above 68. And then we went up above 69 and found sellers above. But now bar 70 is a low 1 on the bear channel line, low in the range. I still think we may come a little lower. We came close to this magnet on this bar, and what we've had here is a spike pullback channel. We might be getting late in the channel phase. We've had 2 or 3 legs down now for the bears, and now we're in the middle or lower third of this trading range. So hard to hold a swing short here, but there are still magnets below that we could test in the last few bars. Getting into the last 10 bars or so, and in general, I like to not take trades in the last 10 bars because lower probability events can happen. The market, we're getting late in the daily chart, and just like how bar 12 can do something drastic to shape the 60-minute bar, the final 10 bars or so can do something pretty low probability and unexpected at the end of the day. And then we had that sell-off, 71, and it went through both magnets, and it's a strong-looking bear breakout. This is a bar that would trap me all the time. It's a strong bear breakout bar, and it's closing well below a lot of bars to the left, but you have to ask where you are in the overall day. And we're still not breaking out of the low of the trading range. So this could easily just be a sell vacuum test of support. And then look at 72. Terrible follow through to buy the close bar. 72, I would get out of shorts above 72. 71 was strong enough for a second leg down, but it's big down, big up, big confusion, and now we're in the lower third of the overall trading range. There's your second leg for the bears. May go a little lower, but 73 is a low 1 and a big bar at the low of a trading range, probably buyers below. 72 was enough that it would probably get a second leg as well. Going a little lower, 74. It's the first bar breaking out below 20. And it's a smaller bar. The bars are getting smaller. There's a tail below. The bears need to do more. They need follow through. 75, another bear bar, but a lot of overlap and a trading range bar. Reduces the probability of buyers above 75. So 3-bar micro channel, probably sellers above, but the context is not great. Getting far from the moving average, and an overall trading range day, we might be low in the range. And then we're getting a bear breakout, 76. Big bear breakout, breaking far below the low of the trading range. But remember what I said about the last 10 bars or so of the day. You get lower probability events. And there's a couple problems with selling 76. If you look at the last 20 bars or so, first of all, what does Al say about, well, actually, I'll touch on that after. So first, we have sell climaxes on the way down, sell climax 58, and then sideways, sell climax, pullback, another bigger sell climax. We're getting a huge sell climax, the biggest one of them all, and it's the third one. So 1, pause 2, pause 3, and an overall trading range day. You know the odds were there were bulls buying the low of the day, and they got trapped. You also know the bears don't want to sell the low of a trading range. 73 is a low one that this is the low probability event. This really, I say in air quotes, was not supposed to happen. And whenever there's a surprise, that's a light one. But you also know you're probably going to come back and retest this price. You have bulls who bought and got trapped, and you have bears who did not sell, and they're trapped out. So we're probably going to come back and test. Also, what does Al say about when you're in a trend for 20 or more bars, and then you suddenly get the strongest, biggest bars? That should be a radar in your head going off that this is suspicious, and it could easily be a climactic end of the trend. And so it is a gap, 76, but it is more likely an exhaustion gap. And what's more likely is we close the gap. And where's the gap? This red line. And you can see what happened on the next bar. 77, big bull bar, almost an outside bar. Obviously, bulls who bought here are disappointed, and they're getting the chance, if they scaled in or not, to get out near their original entry, and they're going to take it. The bears may not be so eager to short in this context, especially after such a big bull bar. Obviously, we're getting late in the day, and big down, big up, probably going more sideways. 78, big bar, but it's a trading range bar. Probably buyers below, sellers above. And then low one triggered, 78, but buyers below. And then 79, buy reversal bar, but bear body and bad context. Probably going more sideways here, sellers above, buyers below. Bear breakout on bar 80. But always ask yourself, breakout of what? Broke out below the past 2 bars, but it's big down, big up, big down. When it's bearish, they buy. When it's bullish, they sell. So we're getting a bear breakout, but you're within the range of the big bull bar, 77. Probably not ideal to be selling. And then small bar, 81 to close off the day. For always in today, I sound like a broken record when I talk about it because most days are trading range days. And on trading range days, always in is not the greatest concept to be trading because once it's always in short, it's time to buy. Once it's always in long, time to sell. Big pair of bear bars here. And it's probably always in short. We had the gap down. We've had all the bars below the moving average. But look at the first 8 bars of the day. It's a trading range. And then you have a bear breakout, bad follow through. So it might be always in short, but you have traders with, for lack of words, they have their fingers basically on their mouse, ready to pull the trigger to get out of their shorts because they're far from the moving average, and this is not above average bearishness. So that's the problem with always in short in trading ranges. Now we have maybe 3 legs down, hard to argue. It's tight enough, it's hard to buy. It's obviously not always in long with price action, but because of context, it's buy low, sell high. So you have traders buying below bars. And then here, I thought this was an always in flip, so above bar 20. Okay to buy for a swing, and okay for bears to get out and look to sell after maybe 10 bars and 2 legs. Here, really no reason for the bulls to exit until I thought 36 would be reasonable to exit below. And then you can buy again above a bull bar closing near its high, like 37, but it's a trading range, forcing you to buy high in a range and after a big bar. And then for always in, reasonable to get out below 46. It might be always in long in here, but when you judge the strength of the rally and you judge the character of the day and the day structure, you're high in a trading range. You get a bar like 46, you need to get out of longs. And the same goes for 52. So bears can sell below 52, bulls probably exit below 52. And then where's the reason? If you did sell 52, give me a good reason to buy. Is there anything you should buy here? Of course not. And then when you get the give up bar here, that's probably a great opportunity to take profits. You're low in the range. A lot of traders will take that bar as a gift. And that's what happened on 72. So is it always in short here? I don't know. I think it's buy low, sell high. We're low. Is 72 and always in flip? I don't know. It's a smaller bar. It's really still buy low, sell high. You probably have buyers below the bar. But then you get 73, a big bear bar, not ideal to be buying below. But also not an ideal low one short in this context. It's confusing. Here, are we always in short? Probably, but then you get this bar, and that's a warning that it could be an exhaustion gap. And another bar that's more of a gift, similar to 71, a buy the close bar. You have strong bears taking profits on a bar like 76. And I do not advise it, but we're far from the moving average on a trading range day after consecutive sell climaxes, the biggest sell climax after 20 bars in the bear trend. So some traders will buy the close of 76 and obviously just sideways into the close. For stop orders today, I thought it was reasonable to sell below bar 8, double top, possible high of the day, and opening swing of the day. Thought the next best stop order was above bar 20. And then all the way up, hard to buy above bars. They force you to buy in bad places. Traders are buying pullbacks in the bull channel. The next best stop order for me, probably 52. I thought 46 was reasonable but did not trigger. And then 52 triggered. You have traders selling below 55 with trapped bulls above. So bears will press their positions. 56, low 1, possibly high in a trading range. You'll have traders selling below that. And then this was interesting. I didn't touch much on it, but this was a wedge. But when you judge the buying pressure, and you're still, it's one leg down maybe for the bears. So we have a couple legs down, a couple legs up, one leg down. You could argue it's two legs down, but this could be one of those places where you get the bear breakout of the wedge because you don't have great buying pressure, and the context really isn't bad. The measured move is around the low of the day. And you can see we vacuumed to it. So you will have bears selling below 70, but you have to be quick to manage the trade. And in order to take that trade, you need your entry bar to be 71. If you don't get 71, basically you don't get immediate follow through. Traders will give up on the trade. It was happening on the way up here. Bulls are buying above bars, hoping for the breakout. You buy above 48. The selling pressure isn't great up here. It's not strong for the bulls, but you're getting a wedge and you're not getting a great sell setup. Traders will buy above 48, hoping we just rally the way that 71 sold off. But when they don't get it 51, they're disappointed and they bail out of the trade, and that's what's happening on 52. And then you can argue 73. I don't know about selling below 73 in this context. And that's about it for stop orders. For limit order trades, buyers below bar 1, sellers above 2, limit order market on the open, buyers below 3, scaling and lower, and then sellers above bars. They don't come in until above bar 3. And then after bar 9, we had this rally. Thought there might be buyers below 9, and scaling in lower, buyers below lower lows. Bulls are doing enough overlap that there are negative gaps, but there are no gaps. And so bulls will buy below swing points, scale in lower, they're able to make money. Bull buys here, and if they scale in, they can make money. They buy below here, they obviously make money. On the way up, I thought there'd be sellers above here, but tight enough rally, it's probably going to get a second leg. Then we get this second leg, but that was also tight enough. And then we didn't get a great sell setup. Sellers above 36, but weak or disappointing entry bar. So if you did sell, you had a chance to exit. And then I thought sellers really above a lot of these bars, betting that the bull channel would not get a breakout and that we were high in a trading range. I thought these were pretty good, 48 and 50, high 1, high 2, high in a trading range, sellers above. And then sellers above these bars, weak reversal attempt after an always in flip. So sellers above 54, and then tight bear channel. The first reversal up will probably fail. Micro channel, sellers above 60. Tight trading range in here with a bear trend or a bear breakout leading up to it. Sellers above bars, buyers below. But if you're buying below, you can get trapped. That's what happened on 71. Probably sellers above 72. It's a tight bear channel. Big down, big up. Probably in a trading range. And that's about all I have for today. Please feel free to leave questions in the comments. And with anything specific to the video, just leave a timestamp and I'll get back to you on that. And I hope everyone has a good rest of their night.